Mastering the psychology of trading is one of the most difficult yet underappreciated elements of learning how to trade markets, regardless of whether one is trading part-time from home or trading professionally for a living. While there are many books, websites, and resources discussing futures market trading strategies, very little has been written specifically about the psychology of trading, particularly for active short-term traders. This could be due to the fact that most technical traders, such as day traders and swing traders, tend to be more mathematically orientated, and therefore less interested in subjects such as psychology. Yet, to ignore the psychology of trading will almost guarantee your failure in learning how to be a consistently profitable online trader. The only time traders and investors turn for help on this topic is after they have blown up their brokerage accounts and have finally hit rock bottom. However, in this video, we intend to improve your trading education by explaining the key psychological emotions to be aware of, and how to avoid the common pitfalls that investors and traders commonly experience while learning to trade. Self-control and discipline. Successful trading is 80% psychological and 20% methodical. Self-knowledge is the key to market success. The trading method by itself, no matter how well thought out, cannot be successful if it is not applied in the correct manner. It is in the application of a trading method that many traders end up losing. Consider the analogy of a high-performance racing car. No matter how aerodynamic or technically advanced, it still needs to be driven. An advanced piece of engineering such as a racing car needs to be driven by a person who can drive it with care. Just as a disciplined driver is needed to race a car, a disciplined trader is needed to apply a trading method. All traders have heard the word discipline, but few really understand what it is and why it is so important to develop it. The emotional roller coaster. You click your mouse to place the trade, however, the overwhelming confidence of paper trading has now deserted you. Perhaps you had better double check that formation. After much deliberation, you decide to click to confirm and the trade enters the market. For the next 2 hours, prices rise dramatically, your profits grow, and you feel great. Suddenly, the next hour prices drop and your profits are cut in half, and you begin to feel uncertain. Perhaps you should take the profit now before it gets away. You decide to wait. The next hour prices fall further and closes below your mental stop loss. Your system is telling you that everything needs to be cut right now. However, you only have a small loss and it should turn around and you will soon be back in profit. The next hour, to your horror, prices have collapsed and the majority of your equity is now lost. Your reaction is now one of anger. Why didn't you bank the profit that you had? The market's move is totally illogical. You feel anger, pain, and frustration, and you are now totally disillusioned and fed up, and all you want to do is exit the trade. Welcome to the real world of trading. As a trader, you will spend most of your time looking for good trades and opportunities. Once you enter a trade, you lose control and either squirm from pain or grin from pleasure. You ride the emotional roller coaster and miss the essential element of winning, the management of your emotions. This inability to manage emotions leads to poor money management of your account, and poor money management leads to destruction of capital. If your mind is not in gear with the markets, or if you ignore chances in mass psychology of crowds, then you have no chance of making money in trading. All winning traders know the importance of psychology in trading, and all losing traders ignore it. Greed and fear. No matter how good your strategy is, the other factor which will always influence your outcome is your own emotions. After all, it is emotions that move the markets. Therefore, the emotions are what most of our indicators are designed to give us a measurement of. And in order to be able to profit on market movements created by the emotions of others, you must first learn how to read the mood behind the move and also how to recognize and control your own. Greed. As prices rise, they naturally attract more attention. As more and more people jump on board the rally, its climb accelerates. But in all the excitement, there is a tendency to confuse account balance, which is the amount actually on your account, with account equity, which is the total value including the sum of your open positions. People begin to treat their potential profits as if they were already realized. This expectation can sometimes cause basic reversal signals to be overlooked. Additionally, those who missed out on the opportunity early on when the trend was still young are becoming hypnotized by the length and the size of this rally. Jumping on board late is a risky game. However, risky is also for those who got in early will eventually need to take their profits. There is also a bit of a greater fool factor here, as anyone who is still buying is now buying at a higher price, and from a seller who has reason to believe that the move may soon be over. The idea then is that hopefully someone will keep on buying after you at an even higher price when you eventually decide to become a seller yourself. Fear. When prices start falling, they awaken fear and panic. Fear is one of our most primal emotions, which explains why prices often fall faster than they rise. People holding longs run for the door trying to sell as quickly as possible, and short sellers motivated by the falling prices add their own orders to the mix. When those short orders are eventually covered in order to realize profit, they are temporary rallies which give false hope. Once one can learn to recognize the signs and interpret them correctly, above all else, the key to developing the skill is practice. Traders, this is the basics of psychology of trading. I recommend listening to the video a few more times, write down the most important aspects to you, and take a hard look at what your psychology and mindset is as a trader. In part 2, we will discuss how emotions manifest on charts and what errors we make as traders when we are not looking at the charts objectively. This is just one example of the many trading strategies you can use at OneUp Trader. In fact, there are no restrictions on how you can trade with us. If you have what it takes, then you can be fully funded within 15 days after signing up. We have funded thousands of traders since we launched in 2017. Take a look at the various testimonials, trader interviews, and funded trader withdrawals on our YouTube channel. You can find everything you need on our FAQ section, and you can speak to our support team, which is available 24 hours a day, 7 days a week. Track your trading performance using our advanced accounts analytics feature. Discuss trading ideas with other traders on the members area and the Discord trading room too. Don't risk your own capital in the markets. Rather, prove your trading ability at OneUp Trader and enjoy a risk-free funded trading account. Click the link below or go to oneuptrader.com to find out more.